My name is Ed Sivak. I am the Chief Policy and Communications Officer here at Hope today. And before we get started, I want to make one announcement and actually one request from all of you. If any of you all are on Twitter, we would highly encourage you to tweet out findings from the day. Our hashtag is hashtag rural places. Please use it. I know these folks are probably on as well. So if you hear something that strikes you, hear something that's provocative, join the conversation, and let's invite others around the country to do the same. So hashtag rural places. I'm really excited to be with this panel today. There's some old friends, some new friends. It's really quite an honor to be gathering together around the topic of increasing scale and impact of community development finance in persistent poverty areas. I really think Bill's framing hit the nail on the head. You know, he spoke of persistent poverty, not just here in the Delta, but in many places around the country. He talked about how often other indicators of distress manifest themselves, whether that's the need for jobs or the need for housing or education and health care. There's probably no other set of institutions more well-positioned to start going at the root of the issues than CDFIs. So without further ado, I'm going to jump into the panel and start with our questions. I really encourage you to check out the bios in our book, and you can see all of the great things that this team has done. So Nick, we're going to start with you. Nick does work down along the U.S.-Mexico border. And you know, as a community development practitioner, one who's been engaged in work in communities along the border for many years, describe how persistent poverty affects access to financial services for peoples and communities that your organization serve, and what are some of the biggest challenges that you face in efforts to close financial service gaps?
Great, thanks. Good morning. It's great to be here. I'm from the Texas Valley. So being here in the Mississippi Valley, I feel right at home. I'm from the U.S.-Mexico border, Brownsville. You may have heard about us on the news recently, and we do have a crisis on the border. It's called persistent poverty, and we are facing it every day, as many folks around the country are in places like the Delta. And so persistent poverty and what's been going on over the last 100 years in our area, if not more, has really created a cesspool of financial products in where we're from. You're going to hear the word financial desert, bank desert. We are a financial desert in the Rio Grande Valley, using the public health definition of that. Financial desert, in a health desert, in a grocery store desert, there is food, right? It's just bad for it. It's Twinkies and donuts. And in our financial desert, we do have financial products. However, these financial products are awful alternatives like payday lending, like Bill had talked about, and car title lending. There's just been over the last I'd say 20 years a saturation of alternative financial products. Just permeating the system. We have, just to give you an example, we have one bank. We have banks in the Rio Grande Valley. We have lots of banks, but we have one bank for every 22 payday and car title lenders. From my office in downtown Brownsville, there are 23 payday lenders within 3 blocks. 85 to 90% of the clients that walk through our door every year, we have about 1,000 clients that come through to buy a house. 85 to 90% of them have at least 2 or 3 payday loans on their credit report. So they're awful, and it's a place that, and they're growing and they're becoming smarter, right? You go to a payday lender and it's no longer looks like a sleazy place that you want to go to. They look like ice cream parlors, and they're inviting, and people come into them, and what they've done is they've taken this awful product, and they've standardized it and made it acceptable. And it really, in our finds, if you make over $50,000, you have no idea what's inside these places. And you go inside, and in Texas, it's 650% interest. And, it's sucking. It's a $5.5 billion business in Texas. And across the country, it just grows and grows and grows in places like the Delta. So that's the issues that we're facing. We've got products, they're just bad. Persistent private just is making it worse. So with that, that's kind of the stage where we're at. And we have tried to create products to fight this, and we talk about that later. But it's when you got money being sucked out of your economy, literally sucked out of your economy, then you can't grow. And when you have 15 cars repossessed every week in Brownsville alone, how do people go to work? And so it's just wonderful.
Well, thanks for starting us off on a high note, Nick. Well, Jesse, NCRC and you really have been on the front lines of the battleground around the Community Reinvestment Act. Communities like the one we're in really exist on the fringe of CRA. In fact, in this area where we're sitting, only one of the 20 largest banks have assessment area. And while we have this conversation, CRA is under attack. So what are some of your main concerns about the proposed changes, particularly with regard to communities like Itabena and other communities in the Mississippi Delta?
Yeah, thanks. So the National Community Reinvestment Coalition, by the way, is a coalition of 600 organizations around the country who champion fairness in banking, housing, and in business. And we were formed in 1990 to save the Community Reinvestment Act, which we successfully did, strengthen the act, but today find ourselves fighting to preserve the core part of CRA and really make CRA more effective, not less. It might be worth mentioning CRA imposes this affirmative obligation on banks to not just not do bad things. A lot of consumer protection law says you can't do bad things. It actually says you must do good things, that banks have this obligation to serve underserved places. They have this obligation to create wealth, to create jobs, to do things that they might not do because it's a little less profitable. And it has had a tremendous impact over the years. I often say, there's this joke, who discovered water? I don't know, but it wasn't the fish. CRA is the water within which we swim. It is around, if you're in housing, if you're in community development. Probably most of the people in this room touch CRA in some way. But it's easy to forget about it. It's easy to think that it hasn't had a tremendous impact. One, because we're facing incredible problems. Inequality has not gotten better. Persistent poverty has not gone away. But two, because CRA involves, proving its impact involves measuring a counterfactual. What would have happened if CRA wasn't there, if there wasn't this obligation? Fortunately, some researchers from the Federal Reserve Bank of Philadelphia looked at this. They looked at areas outside of Philadelphia that suddenly went from being low, moderate income, qualified for CRA, to being no longer qualified. And they documented a 10 to 20% drop in lending in those places over the next several years. Just to extrapolate that, that's over a period of 3 to 5 years, a $50 to $100 billion drop in lending to low and moderate income people nationwide if CRA were to go away. By the way, that's really a very conservative estimate because it's just looking at place, not at low-income borrowers. Just the smallest banks, and I think this is really relevant for where we sit today, intermediate small banks, banks with $300 million in assets to $1.2 billion in assets, do, under CRA, almost $3 billion a year in community development lending and financing, and investments, rather. $3 billion a year, that's almost the entire size of the HUD CDBG budget. And this is relevant because in the current reform process, there's a proposal to raise the threshold and say they no longer have to do it. They no longer have to be examined for community development. The largest 20 banks in the country, by the way, do about $35 billion a year in community development loans and investments. So as we sit here today, CRA is under attack. There's a proposal to loosen up assessment areas, to allow banks to go beyond where they're based, which may sound appealing in a rural context. I'd suggest what we really need to do is target it to areas of persistent poverty, to think about ways to motivate lending and investing in rural areas, because there is no guarantee that if you broaden that sort of examination of banks, that money will flow to places like Itapeva, Mississippi. In fact, one of the leading ideas from the comptroller of the currency is to boil CRA down to sort of one metric in which you take up your obligations, size the bank, divided by what the bank does under CRA, and as long as you hit a certain ratio, you pass. That will largely drive CRA activity to mortgage, to the lowest risk, highest return, lowest effort type activities. Mortgages in gentrifying areas, no matter where that is, if you do that. So we do have some serious concerns about the current reform process. I think there are ideas. This is an opportunity to make CRA more effective. I mean, I think the problem is when we get caught in these conversations in which we're dividing, a shrinking pie, we're almost by definition going to be at odds with each other. I think what we really need to argue for, what now is a moment to argue for, is a bigger pie. We cut the corporate tax rate significantly, billions and billions of dollars of benefit to private corporations without asking much in return. And we need the banks, we need the mortgage companies, we need insurance companies, we need them investing in places like Itapeva, doing more to address inequality, doing more to address the racial wealth gap, doing more to address persistent poverty. It's the challenge, of our time. And if we don't address it, I really believe, and as someone with an 8-year-old boy who scares the hell out of me, I really believe we could have riots again. I really believe we could get to a place where society fractures to such an extent. You already see it. There is, 2 Americas, or maybe even 10 Americas, gradations of poverty that most people in this country don't really see. So I applaud Bill, I applaud Hope for bringing us here today to the Delta to tackle these significant challenges.
Thanks, Jesse. So bigger pie, hashtag rural places. Is that what I'm hearing?
Put it on the hashtag.
And I think the point you made is a really important one. We actually looked at this in our region. If you look at the Southeast, there's no other source of funding or resource base larger than the Community Reinvestment Act for community development purposes. Not philanthropy, not the New Markets Tax Credit, not other programs through the CDFI fund. CRA far exceeds the types of investments going into low-income communities of all those other sources. So again, just re-emphasizing that point, contextualizing it for our
beautiful years at the Ford Foundation, to be at an Aspen think tank, to serve in the Obama administration as Undersecretary of Rural, and now to fight for CDFIs. And I'm convinced we know what to do. We know that the money, we put these laws. Why are we talking about CRA this morning? You know, not only because it's topical and necessary, but it's because it's a driver of money. We don't do this alone. CRA is ultimately a partnered program. It has changed the way banks move money into the poorest communities around which they are based. And it's been tremendously successful. For our community development financial institutions, it's meant billions of dollars. The sheet you have on your table there, we say we have $3 billion in borrowed capital. It's leveraged up to another $14 billion. So we actually know something about how to take more regulated financing out of the banking industry and partner it. And it's groups like HOPE. HOPE is a certified community development financial institution. It uses a credit union anchor, it combines it with a loan fund. And because of this flexible and hardworking combination where there is subsidy and legs and HOPE team, we get what we saw in Moorhead. We get financial institutions that get rid of those check cashers. You know, we get home mortgages that make sense. We get investment into the places. So my big lessons is kind of simple. 30 years of thinking about this. We do need the flows to be bigger, whether those are private flows from the banking industry, public flows. That pie does need to grow. And it's not a crazy pie. It's things that America believes in. We believe in things like broadband and clean water and sewage treatment. We believe in home ownership. These are core values that our electeds from across the aisle support. And those line items exist. They're hidden sometimes. They're sitting in the Department of Agriculture, which you think is for the soybeans, but it's also for the people. And so we need that pie to grow. But we also need the hands that are smart about pushing it into areas of persistent poverty. And this is where I'm so proud to argue for our community development financial institutions. Because I think we, the community development financial institutions field, are just dedicated. We're mission money. We're just going to help every dollar in our hands. We're going to push it to where it's most needed. And that's the genius of this kind of partnership. Everybody doesn't need to do this, but we need to invest in the thin end of the spear that's going to get to the Moorheads. And I'm so glad HOPE is named HOPE, because what it really means to me is when it comes to these big flows, it can feel systemically exhausting, like how are we ever going to change things? It's been poor for 30 years, 40 years, and we got a big history lesson last night, and this didn't happen by accident. But I think the hope is that it's here. We actually know how to make a mortgage. We know how to put in fiber optic cable. We know how to fix water systems. And we actually know how to loan for those things. So to me, it's not that far. And if we want these flows to move, we have to be serious about the kind of money. We need to count in billions. And we need to be serious about the partners that are needed. And we know something about those partners. And CDFIs are the kind of partners that can help us push that into areas of persistent poverty.
Deep partnership with CDFIs from around the country to implement the Tendo small business program. Talk about why this work is so important, maybe give a little bit of background on the program, and let's start there.
Goldman Sachs and the Urban Investment Group are doing. I love that I'm following Lisa on this because and she knows this, I'm a big fan of CDFIs. I'm very passionate about the work that they do. And just to give a little bit of background around 10,000 Small Businesses, I don't know how many of you here are familiar with this program, but I was fortunate enough to be part of the team that helped launch this program back in 2009. And I remember that we had a sort of a theory of change in mind when we started to sort of design this program, right? Lots of very smart people got in the room and were like, okay, there is a system here that we need to address, right? It's not just about bringing money, and it's not just about bringing education. There are several elements that need to be present in order for this ecosystem to work. So, and that's sort of the genesis of the 10,000 Small Businesses program, because it's a program that, in its essence, it's about job creation, high quality job creation and growth. For small businesses, for your sort of, as they call it, Main Street small businesses. And so, as we right? And then I remember very clearly this time in my career, I was just a very young investment banker with a lot of passion for community. Around the time when I was introduced to CDFIs, and I remember the first time I met with the CDFI and started to get to know them and look through their balance sheet and understanding them as a business model, we fell in love with them. Right? In that moment, it became clear to us that our greatest impact was really going to be to tap into the CDFIs and help them fulfill their mission. So in other words, for us, it became very clear that the highest impact for our capital wasn't in providing capital to high scalable intermediaries, but rather to smaller, sort of highly local, mission-driven lenders. So fast forward 7 years, today we've deployed $192 million in partnerships across 30 different CDFIs across the country, many of which are in rural areas. We have a very strong partnership with Hope, which I am hoping, pun intended, we will strengthen and increase actually in the coming years. It's my vision and my dream, and Bill knows this. But we've done this in rural areas around the country, and I think there is something to be said to say that when there is willingness, right, when there is interest in learning from the ground up, there is a way, right? So for us, our approach to community development has always been, if we want to underwrite a market or an organization, the best approach is to go there and meet them where they are, right? Let's not fly them to New York. Forget about New York. Let's get on a plane, go as far as we have to go, and see the faces of the people that we're trying to help. Not every bank does it this way, but we're very proud that that's our method, that's our approach. And we're I'm very happy to be here, and thank you for having me.
You're welcome, Laura. So with that last statement, we talk about that a lot at Hope, is we got to meet people where they are, and when people come through our doors, we often say, someone's not ready for a car loan or a mortgage. We don't say no, we say not yet, and then we figure out a way to get folks there. So I'm feeling you on that one. So, well, Dan, you've been in banking a long time, and you've seen the industry evolve. And so I was wondering if you could talk about what are the implications of this evolution for rural communities like the ones we're in today?
Okay, so the history of banking in 3 minutes or less, with the Federal Reserve in the House taking notes and grading my answer afterwards. Thanks, Ed. So I would have to say, look, I'll pick one, the single most significant long-term trend that I've experienced in the last 30 years is the dramatic and consistent consolidation and concentration in the banking business. Right? I think back 30 years ago when I started, if you look at the 4 largest banks in America at that point, and together, the 4 largest banks in America had about a little less than 10% market share, deposits and loans. Fast forward to today, the 4 largest banks in America today have over 40%, or 0% market share. And that is a steady, consistent trend over the period of time. And I would suggest that's not an end point that we have reached, but that the economic drivers and the efficiencies, core economies of scale in that business will continue to drive us in that direction. If you look at the other post-industrialized countries across the world, we actually have some of the least concentrated banking. Right? If you go to the United Kingdom, just banks there, they together account for 67% of deposits and assets in the UK. The average for all Western European economies is a little over 60% market share in the top 4 banks. Go to Australia, the number's over 70%. New Zealand, the number's over 80%. In Canada, the 5 largest banks in Canada have a market share of 92%. We are on a path with economic drivers to increase consolidation, increase concentration. So what? So what? I think the so what is in an environment, in a post-Great Recessionary environment, where the expectations we all have is for predictability, more predictability in our banking institutions, where regulators, and I'll let them speak for themselves, expect and demand predictability, where the investors in banking institutions want predictability, and I would say every single banker in the room has experienced in their own institution a drive for predictability, standardization, and I would say in some regards, rigidity in approach. Those who think of large financial institutions as ever-increasing sizes that are credit factories often envision that assembly line of square holes looking for square pegs. Right? It has been almost 10 years since I personally heard a banker ponder the question in an application. I wonder whether or not this borrower will be able to repay the loan. So the question that's asked and the way it's formed is whether or not this applicant fits our credit profile. Does this loan fit our box? Right? That describes a rigidity in approach that is increasing over time. And here's the real so what for me. When we think of low income and minority communities, that's where there's least likely to have the perfect round peg fitting the perfect round hole. When we think from a cash flow perspective or the income of individuals, there's less likely that that has been consistent over time and demonstrated as consistent. The collateral we look at is less likely to be either liquid or more likely to be highly leveraged in the loan request. And the credit history is less likely to be unblemished. The problem of an ever-increasing consolidation, while it has true benefits for an economy as a whole, when you combine that with a drive to predictability, and I'd say rigidity in many regards, is it leaves out individuals that don't fit in that rigid profile. Here's what I would say, though, after 26 years of working with only CDFIs. CDFIs are the antidote for a rigid credit system. I have never heard a CDFI or representative of a CDFI ask the question, I wonder whether this client fits our box. If I ever hear that, I'm not invested in that CDFI. So it's been my pleasure to work with CDFIs for 26 years. We have a portfolio of $1.6 billion invested in 245 CDFIs across the country. Right? We see that CDFIs are an antidote to rigidity in the system, but it's not like CDFIs are giving the capital away. Right? Our portfolio of loans and investments in CDFIs has a superior track record. In fact, a repayment track record that rivals any other asset class in Bank of America. After 26 years, $1.6 billion, let me just say this, investing in CDFIs is good business. in addition to being the antidote for rigidity in the credit system. So I would just say over this conversation, if you don't know CDFIs, connect your CDFIs. If you do, figure out how we can bring more capital to what I view as an antidote to so many of the issues that my fellow panelists addressed. Thanks.
You know, some of those comments, it reminded me of being at Hope during the financial crisis, 2008. And at that time, our portfolio did as well as any in the country, and in fact, better than most. And we see that often during times of economic downturn. And so, you know, those comments resonate deeply. So Nick, as we turn the conversation to focus on solutions, and again, that's a goal of our conversation today. So what do we do about persistent poverty? What would be the most impactful action that banks or policymakers could do to close financial service gaps that confront communities like the one in which you operate?
This is the best question. Money. A couple of weeks ago, I had a tour that came through the Rio Grande Valley, and they were some of the wealthiest folks from the Boston area. Came to visit us, individual investors, and they wanted to see what we were doing and see if we were a place they wanted to put their money. And had a great tour, and showed them a bunch of places. And I had done kind of the longer, obviously, speech that I had done about payday lending and cartile lending, and awful mortgages that we see in places like the Delta and the Rio Grande Valley. And I had given the stat, $5.5 billion business in the state of Texas. And this one gentleman who's kind of leader of the group says, well, if we were to invest, how much money do you need? And I said, did you not hear me? I said, $5.5 billion business. And they all laughed. And I said, I'm not laughing. It's a $5.5 billion business in the state of Texas. CDFIs are invested with banks, philanthropy, with individuals. And you did a tour here yesterday, and you've done a tour, and some of you have been to the Rio Grande Valley, and you've been to Indian Country, and you've been to Appalachia. We didn't get here overnight with $200,000. So it's going to take a bunch of money, like $5.5 billion in Texas, to get out of the cartile payday lending problem. So we're talking about real investments are needed. And then, back to the questions, also help us go places where clients are at. And I physically mean where clients are at. Not just where they are financially, we need to do that, and we've been doing that, but help us go to where clients are at, like laundromats. We're doing stuff in laundromats now, because that's where people are at. I literally, when they came to me and my staff said, we gotta go to laundromats, I'm like, laundromats? But I went to a laundromat. I hadn't been to a laundromat since, I was single. I sat around a laundromat for an hour and a half. You make a lot of money in laundromats. But, and learn, hey, we could be here in health clinics. We've now got financial counselors who are sitting in health clinics. They're sitting there waiting. Why not try to get financially healthy as well? And we ask those philanthropy, we ask the CRA, we ask the banks, invest in R&D. So I'm kind of known for having the crazy ideas, like the community loan center that we're now doing, and we have 20 franchises across the country, which was to combat, payday and cartile lending. I've created a mortgage product called the Mi Casita mortgage product, which takes a small house and makes it grow, and helps families grow and build onto this house. And actually, working with Freddie and Fannie and the Federal Home Loan Bank System to buy these mortgages. But it took time to think about these things and time to test them, right? You want to invest in us, invest in our R&D. So crazy people like me can sit around and come up with these ideas and make you look really good. And like Dan said, lots of money. And then CRA, there's a lot of changes to CRA, and Jesse's going to be able to answer all those questions, and I agree with most of them. But there is a push where we do need some work around these tier 1, tier 2, tier 3 places where you may have a bank or not, and we need their funding, but they can't invest in you because they're not in that footprint. We need to work on that. And then my final thing, this is probably gonna get me thrown out of here, but I'm used to that. To my brothers and sisters in the CDFI world, stop acting like banks. You're not a bank. You are a CDFI. And Dan said, I don't see, they never ask the question, do they fit within our credit profile? Dan, we don't let you in those meetings. They do ask that, and then more and more every day. I do unsecured $1,000 loans to people that work on the ship, channel in Brownsville. Unsecured. I'm not losing money. I'm doing pretty well. But I'm as crazy as they come, but I'm in a place where nobody else will go. And that's what CDFIs are supposed to do. And if we start pulling away from those and acting like little banks, then we don't need you. I mean, I'm telling you the truth. I get tired of, let's talk about the risk. Let's talk about the risk. I'm there. I know, I understand. But, we have regular banks to do that. And in most cases, they're filling some holes and they're filling some gaps. But we're not doing that. I'm not talking about being crazy. I'm not talking about being nuts, although I've been called those things. Let's be the lender that won't go there, because and we know our community. I know I can only do $1,000 because I know where you work and I know where you live.
You can stay. Jesse, so let's talk about CRA. Specifically, what do we need to do to make sure that it's effective in rural persistent poverty places?
Well, my solution on that is my solution for everything, which is we need to organize. And I want to go back to what Dan said, because I started questioning whether he's here working for Bank of America or someone else as he was talking. And I think he's exactly right. The history of the banking industry is consolidation. It will be the future history of the banking industry. It is happening right now. BB&T just announced it's buying SunTrust that will create the 6th largest bank in the country. And I would push back, though, just a little bit on this notion that it has produced benefits for the economy as a whole. I mean, you don't have to believe me on this. Federal Reserve Board Governor Daniel Tarullo, some years ago at a research conference, said there is very little research evidence that the benefits the banks have claimed as a result of consolidation, economies of scale, etc., are true. Federal Reserve Board Governor Daniel Tarullo said that. He said that's the theory, that is what we have claimed. It works sort of from an economics perspective, but in reality, we have not seen lower prices, we have not seen kinds of public benefits. And so, we at NCRC have said, as banks grow, we shouldn't have an antitrust standard or an anti-competitive standard that says once you get so big that you can no longer grow, you can no longer buy other banks. That's a problem if there's an anti-competitive effect. No, I think that as banks consolidate, we'll have a standard that says as they grow, they should do more to benefit, in particular, low and moderate income communities and communities of color. That as they increase their capability, there ought to be a greater standard, that 1 + 1 shouldn't equal 2 or less, it should equal 3 or more. And I do think as banks merge, as they grow, that is the question that we need to be asking. But every person in this room who is concerned about that should be focused on the fact that BB&T is buying SunTrust. And that is both an opportunity and a threat to our work. The same thing with Community Reinvestment Act reform. I hope that every person, every organization in this room submitted a comment letter. I hope that every person is focused and engaged and energized around this, because We ought to be asking for more, not less. It's why we worked with Senator Elizabeth Warren on her American Housing and Economic Mobility Act, which would modernize CRA, expand it to mortgage lenders, expand it in significant ways, increase its impact. That bill, by the way, also would address historic redlining through targeting, based on research of ours, down payment assistance to formerly redlined areas for home ownership for people in those places. It's a bold vision for what we could do to address something that too few people are talking about. We have an affordability crisis in this country in housing. We have home ownership that is near 50-year low. And we can't solve these problems with more money, but we're not going to get the money if we don't organize. And so I hope that every single group in this room gets involved in these kinds of issues. Derek was talking last night about racism. He said it's about the money. It's about cheap labor. It has always been about that. It's not just about that, but it has always been about that. I often get asked, when we have these debates, is it race? Is it class? Yes, it is. Martin King, when he gave his final speech in Memphis, which is my hometown, said, whenever Pharaoh wanted to prolong slavery, he had a favorite method of doing so. He kept the slaves fighting amongst themselves. It is our lack of ability to get organized at every level, grassroots level, community level, the national level. It is our lack of ability to work together to fight for more that is holding us back. And it has been that way, and it will be that way until we get really serious. And as Nick said, somebody has to. A lot of people talk about collaboration. A lot of people talk about innovation. Nobody funds it. I've yet to have a funder come to me and say, "Boy, we think you do great work, and we want to continue to support your great work, and we also want to give you some money to collaborate with other people to innovate and to organize." And that is what we need if we're going to tackle these issues. And I think, within the CRA context, just to go narrow for a moment, I think we need to be really clear about what the issues are. Two of the banks in this region, BB&T and Regions, have 25% and 70%, respectively, of their community development and loans and assessment and loans and investments outside of their assessment areas. They are getting credit for activity outside of their assessment areas. The issue is they don't necessarily have clarity that they are going to get it. They get into the exam, they argue for it, they have done it, and at a significant level, they are getting credit for it. We need to make sure that they have the clarity that allows them to invest and continue to invest in organizations like Hope, etc.
Thanks, Jesse. Lisa, working with you and Bill over the years, one of the things that we always got to prep ourselves for is reaching farther, thinking bigger. What is the next bigger thing that we need to be working towards to solve these problems?
That's a really fun question. And if you have been around Bill Bynum, the number keeps getting bigger and the goal keeps getting bigger. And I think it's really the right way to walk in the world. And so, Nick, you helped us out with your $5.5 billion for one state in order to change a market. You are all holding the mobility report in your packets, where after being with Raj Chetty and the illustrious group, Bill and his colleagues put together a paper that called for $1 billion fund for CDFIs working in areas of poverty. And it's that map, those red areas, which by the way are urban and rural, but this is a rural spaces, rural places conference. And I called up Bill some weeks ago and I said, Bill, I think the number's too low. And even though we haven't even raised $1 billion yet, and here's why. I got to my desk at the Department of Agriculture, and my job was to go in front of Congress and argue for my annual budget. And that's kind of what some cabinet official does. So you get prepped for being tortured by the members of Congress, but your job is to argue for the budget. And my budget was $30 billion, mostly in loans and investments. And a lot of that was loan guarantees for individual mortgages. And that whole $30 billion was made possible by about $3 billion of taxpayer, appropriated dollars. And I started to realize, one little division hidden inside the Department of Agriculture unleashed a lot of good with that. Who was in Moorhead yesterday? And you saw the story of the water sewer challenges. That was in that budget. It's already stuff that we as taxpayers are committed to. And so I've started to realize that if we were appropriately partnered and could put our claim not only on what banks are doing, that is huge. That's why we mixed the issues on this panel. We're not going to give up on our CRA, no matter how much consolidation we get, because it's too important. And there's a big tent of CDFIs, there are credit unions and banks and venture funds and small business funds that can help move that. But if one little division inside of the Department of Agriculture was responsible for $30 billion of investment throughout all of rural America, from Alaska to Hawaii, then our eyes have to be bigger. And that's appropriated, and that's a lot of loans. I believe that more is possible in expanding some of the very programs that already exist. Very few people would raise their hand and say, we don't need any more broadband in rural America. It's across the aisle. People understand you can't create one of Laura's businesses if you can't sell it anywhere. And many people would choose to live right here if they could sell it, but they need high-speed fiber optic cable, and that's already in the budget. So my view is that, I mean it, we gotta count in billions. I agree completely with the mobility paper that we gotta get a new fund that's committed to persistent poverty, that has many layers of investment from different sizes, and that's our first billion. But I think where we gotta push is we have to think of that map. This is 2019. We have to we gotta stop being scared. And that civil rights fight is not over. It's time to really point firepower at those red or purple, whatever the map shows, areas. And that's gonna take more funds and more partners. So I want our eyes to be lifted up. It's time for America to take care of all Americans. We can do this. If you haven't gone with Nick yet, to see the kind of homes he's able to build in Brownsville. More is happening in Brownsville than what we see on TV. There are so many families getting into high quality, standard, healthy homes, and Nick does it. He builds it. So we know how to do this. So get our eyes above. We have the agencies. This is a powerful, sophisticated economy. And I think the 1 billion fund is our down payment toward the real billions that must flow in our public resources and our private resources to really make a dent in that map. It is time that all the Moorheads of this country stop having to wake up in homes that are substandard and get partnered with the Hopes or the CDCs of Brownsville. We know how to do this, and they're resource starved. So I'm gonna go bigger than the number. I'm gonna count billions. I'm gonna say if I ran 1 year's budget at 30 billion and got all those dollars repaid, we've got more work to do. So,
all right.
I'm signing up for it too.
I'm on your team. Laura, one of the things I had a chance to talk with you a little bit last night, and one of the statements that really resonated was the statement that some of the most inspiring work that you've seen is outside of New York City.
Yes.
All right, see, it's spoken into existence. How do you see an institution like Goldman Sachs, working to increase the scale and impact of this work outside of New York City, in rural communities? Particularly, I'd ask you to focus on the rural communities. We went through Eastmore yesterday. You're in the small business arena, so how can an institution like Goldman Sachs be part of that solution?
Yeah, I think, first of all, being present, right? So, like I'm here today, and I think being present and taking real time to get to know the communities. You see, the challenges for large organizations such as Goldman Sachs is that to underwrite a location or an organization, there is a fixed cost to that, right? So when you think about coming into a new market, if you don't know anyone, right, and if you don't have any connections or any networks you can tap into, there is a fixed cost just to understand that market and just to kind of get to know whether or not that would be a viable market to invest in. And that's where I think CDFIs come in. And actually, I was talking to someone last night about this. I think CDFIs have such a potential to serve as the great conduits to manage and organize the flow of resources into communities in need. Because I can come here as much as I can, but I will never know the needs of this community more than Bill's organization. And so if I need to understand what can we do about this area of the country, Bill will be my first phone call. So I think for CDFIs, I think about it as sort of like, and I'll go back to your original question in a second, but I almost want to urge CDFIs, coming from sort of like my position as a banker at Goldman, it's almost like think about what you're dealing with in your position in the ecosystem and how can you leverage your position in the ecosystem as much as possible, right? So I think about it in terms of supply and demand. You know what the demand is, you know where the problems are, you know where the capital needs to go to solve problems. So the demand part, you've got it. The supply of capital, the supply of resources is where you're most valuable. And I think about that part of the equation in three parts, right? I think about it in terms of thinking of yourselves as a CDFI as a great organizer of resources, of people, of capital, right? Essentially tapping into the power of networks. So for me, for example, when I come to meet a CDFI, I'm very curious, not only about are they strong, mission-driven, et cetera, but my real question is, do they understand what's going on the ground? Are they in touch with the people they're trying to serve, right? And I think that's sort of the organizer power of CDFIs and sort of like on the ground, local, hyper-local power that you have. The second way I think about it is, think about, for instance, opportunity zones, right? So because of opportunity zones, you have a number of new investors that would never think to invest in certain parts of the country that are now looking into investing in those parts of the country. So I think CDFIs could take a lot of advantage of kind of stepping into a leadership role to basically hold the hands of those investors so they know where to put their money, right? In other words, you serve as almost like the great convener of resources to guide those investors, because they have no idea, right? They just want to put their money to work, but they don't know. You know, right? You know more than any of us can ever know. And then the third thing that I think CDFIs can do to help me help them, right, is to think in terms of how can you improve your technology and your R&D? How can you invest in research and development? I know your resources are scarce, but for example, in 10,000 Small Businesses, for every lending facility I do to a CDFI, I pair it with a capacity building grant. So if I do a loan facility to a CDFI and they show me a proposal that demonstrates that they have a sort of an R&D initiative that will be transformative for the organization, I will pitch the hell out of that internally, right? Because to me, that is what's going to be the tipping point for that organization. So I think it's a long answer to your question, but when I think in terms of what an organization like Goldman can do, I think we can do by being present, And by helping our partners, I mean, those of you who are partners on the 10KSB 10,000 Small Businesses program, you know that a lot of what I do on my day-to-day work, I mean, obviously I do loans, I write checks on all of that, and that's great, but a lot of what I do is sitting down with the leaders of the CDFIs that are part of the 10,000 Small Business program and thinking through these problems with them as a sort of like peer partner, right? I'm their partner. So yeah, I think being a thought leader with them and a thought partner with them and in a sort of a sustainable and reliable capital provider, in being present with them on the ground.
Thanks, Laura. Dan, I've heard you make the statement before, particularly when we were getting together around Uplift America and the Community Facilities Relending Program, which is a program that directs capital for facility development in persistent poverty places. One of the attractive elements of it is that folks from the Delta and Appalachia and Native communities and were actually got together, and you didn't have to pick. So, what do you see as the greatest opportunity for collaboration between banks and CDFIs and rural communities along that framework? And also, too, if you could address the unique aspect of community development credit unions and what they bring to play in that space.
Okay, let me start at that second point first. So, when you look at, let me share a few numbers with you. If you haven't figured out, I'm a son of a statistics professor, so that's where I go. When you look at CDFIs in America and you look in California, there are 95 CDFIs in California, and in New York, there are 82, it's the second largest, 82 CDFIs. The state with the third largest number of CDFIs, Mississippi, 79. Here's the interesting thing when you dig down one level deeper. So in California, out of those 92 CDFIs, 60 of them are loan funds. And in New York, out of the 82 CDFIs, 55 of them are loan funds. The remainder being CDFI banks or CDFI credit unions. And in Mississippi, the number of loan funds are 3. And in Alabama, it's 2. And in New Orleans, in Louisiana, it's 2. The data you see on your table about the capital difference of where banking institutions and private investors are putting in capital not only impacts the amount of capital, but it impacts the form of the CDFIs in our respective communities. Because when you're looking in New York or California at a loan fund, that organization is bringing in bank capital, philanthropic capital, private sector capital, and it gives it a flexibility of acting. When you have less capital, private sector capital, the strategy, as it is here in Mississippi, is to change and realize that without that private flexible capital, the way to go, the only way to go, is to create a CDFI bank or CDFI credit union, because then you can access deposits. You don't have to convince Bank of America, Goldman Sachs, JP Morgan Chase to put capital investments in. You can get that via deposits. But here's the issue. When you opt for that charter and attract deposits, you opt into the oversight and the regulation and the risk restrictions that come along with it. By necessity and quite fairly, the government is guaranteeing all of those deposits, and so they're going to overlook and say what you can and can't do. I'm a huge fan of CDFI banks and CDFI credit unions. They often provide banking services that are not otherwise provided, so it's a huge service. But from a credit provision and flexibility perspective, we need more private capital that allows the growth of loan funds. So my encouragement from a policy perspective would entail the following. First, where we need greater flexible capital, as it was described at Some CDFIs behave as banks. Many CDFIs behave as banks if they're receiving deposits that cause them to behave banks. Not all. I agree that some have become overly conservative. We need to create, in addition to CDFI credit unions and banks that provide banking services, where they're not depository services, we need to create more and larger CDFI loan funds. That's where we need to push more from a policy perspective and encouragement, number one. Number two, to Lisa's perspective, not only, and Jesse's, not only do we need to create policy that ensures that private investors and banks are going to get CRA credit to encourage them to do activities in rural areas where their assessment areas may not be. But we need to connect and realize that the government can work through CDFIs, not just in the CDFI fund in the Department of Treasury, but in all of the departments that are dealing with human development and community development issues. So it's the Small Business Administration serving small businesses, and they can do it through CDFIs. And the Department of Education, who has learned that in their push for education and charter schools, they can work with CDFIs and Health and Human Services and HUD, the VA. I can't think actually of a government agency that couldn't do a better job of leveraging and stretching their financial resources by deploying them through community development financial institutions. And the last thing I would suggest is an awareness. So I'm from New York. I spent most of my time, most of my career focusing in the early days on urban poverty. It was not until a little over a decade ago that I came down with Bill and Alan and others in the organization. They took me on a tour, and I began to learn that rural poverty has drivers and issues and challenges that are fundamentally different than urban poverty. And the strategies that address that poverty is different. If you're not aware of those challenges, and you're not aware of the existence of the CDFIs and the CDFI loan funds that you can deploy, then we'll never end up moving to that. So I want to applaud folks both in the room, the sponsors, and the Fed for agreeing to come. We need greater awareness, both of the elements of the problem and of the CDFI industries, credit unions, and loan funds that are potential solutions to those issues. So thank you for inviting me.
Great. Well, thank you, Dan. And we are getting close to wrap-up time, so I just run down the panel one more time. If panelists want to take about 60 seconds, just key messages, key points that you'd like to leave with the audience today.
Thank you all for coming. It's I think working with and closely with CDFIs, whether you are philanthropy or banks, is the way to go in the communities where we are. We understand them. We know where to be. We know how to deliver the product. And I encourage those who are looking at places like the Rio Grande Valley, like the Delta, like Appalachia, to search out the CDFIs that are really making a difference, whether it be around mortgages, small business lending, consumer finance. We are the groups that are doing the work, and we look for partners and we desire partners.
Well, I'd say organize, organize, organize. You really need to have a more fundamental conversation in this country about poverty and about what's going on in places like the Delta, but other places too. I think Derek Johnson said last night there's a lot of poor people, probably lots of poor white people too, and I think that we can do a better job of organizing those communities. I mean, I think a lot of people, I won't start talking about Trump, but the phenomenon of people voting, or in most cases really not voting, because they're so frustrated because their economic conditions are not getting better is real, and we need to do something about that. We need to focus there. We need to have white people talking to white people about race, and we need to have conversations about what are the systems that are keeping people in poverty, a great number of people in many parts of the country of all walks of life. And to Bill's earlier point, it is an issue for the economy. It is an issue for the future of our country. It is an issue that we cannot afford to not tackle. It is as significant, if not more so, as climate change in terms of a threat to our very existence, I believe. And we need to think of it in those terms. We need to be bold about our solutions. We have to, as Lisa says, count in billions, or I'd even dare to use the T word, trillions. That's what we need to do to fundamentally transform our economy in a way in which more people participate in it, we produce more wealth, we produce better outcomes for everybody.
This is a fun road to be in. All right. Rural Places and Rural Spaces is the name of this event, and I'm just very thankful to be in this region and to see its beauty, to remember its pain, and to see its future. And that future is going to take all of us. The trillion is our national budget, and as taxpayers. And my just overwhelming sense is that we have building blocks here. And building blocks are blocks like hope. And it's time to finish this work. People deserve a decent place to live. We can fix this housing. They deserve businesses that can flourish. And they deserve a future for the kids that are here and grow up to be the green jacketed people. And in all of that work, how fortunate that we don't have to invent CDFIs. They're here, ready to play, I think, a more significant role in communities of poverty to do the work that we really need to do. So I'm thrilled to be back in Mississippi, to be at a rural places, rural spaces, and to claim what we need to do together.
So I think I'll piggyback off of that, and I'll talk to the CDFIs in the room that are trying to help rural parts of the country. And I think what I will say in 60 seconds or less is that, you know, if I were in your shoes, I would really try to understand my place in the ecosystem and really empower myself, right? You have a lot of power because you are sort of the drivers in some ways of the solution. Because, for example, when we did the Eastmore investment, Goldman, we did it because Bill picked up the phone and called us and told us about it, right? He wasn't intimidated by the fact that my group is called the Urban Investment Group. He just called us and he was like, you know, I got something over here, it's rural, does it matter? I was like, no, it doesn't matter, right? So don't be intimidated. And, you know, and we did the investment because of that one phone call from Bill, right? So I think the key message I want to leave you with is, you know, look at the power that you have to be the great organizer and the great convener of resources. Don't be intimidated by the guys in New York or gals. And do think of us as partners. You know, our lines are open.
So thank you, Ed, and thank you, Bill, for inviting me and allowing me to participate and attend this. For the past 26 years, it's been my honor and my privilege to work with community development financial institutions and exclusively with community development financial institutions. They are the most innovative, creative, flexible, and impactful organizations and investors that I know. Community development financial institutions. They are organizations that exist and live with one foot firmly planted in the mission of advancing communities that we live, underserved communities. They are also financial institutions, bringing all of the financial resources and the ability to lend and invest. They are unique institutions that we need to support and need to grow so much greater. I would say this for every person in the room. We can put our personal capital safely into community development financial institutions. And at every individual, at the institutions you are working, you can find ways to encourage them to deploy capital safely and productively into community development financial institutions. Our portfolio is $1.6 billion and growing, but the need is far greater than that. And it's not just the CDFI fund or banks and large banks, although we clearly have a responsibility to grow ours. It's every institution that you are working in has the opportunity to take some capital and deploy it in CDFIs, and then every individual in the room has the opportunity to invest some portion of our individual capital safely into CDFIs. The need and the impact and the urgency of the issue you hear here is tremendous. I'm simply here to tell you that after 26 years of working with CDFIs, I don't know a more safer, more impactful place that you can deploy your capital. And if you don't know where to find the CDFI to deploy your capital, call us. We'll help you.
All right, so as we wrap, a number of themes that I just want to emphasize as we transition to the next phase of our conference. Meet people where they are. That is a characteristic that is fundamental to our identity as a community-owned financial institution at Hope. Implicit in that is the need to organize for better policy, organize for resources, which demands of us that we partner and we actually work together in a meaningful way where there's risk. And finally, hopefully the outcome of that is a bigger pie for all of us, not one that we fight over, but one that we expand so that we can reach more people and places. So join me in thanking our panel.